All right, today we're diving into something super interesting, a pattern that a lot of traders believe can help you spot the footprints of big institutions in the market. We're talking about the fair value gap. Let's get right into it.
You know that feeling, right? You're watching a chart and the price just shoots in one direction, leaving this empty space behind. And you're sitting there thinking, whoa, what just happened? Did I miss some news? Well, that little gap, that might be the biggest clue on your entire screen.
So, here's how we're going to break it down today. First, we'll cover what these gaps actually are. Then, we'll get into the fun part, who or what is causing them. After that, we'll walk through a basic strategy, how to make that strategy even stronger, and finally, what you absolutely need to watch out for. Okay, let's start with the basics. Let's put on our detective hats. The very first piece of evidence we need to understand is the gap itself. What are we actually looking at? A fair value gap, or FVG for short, is really just a specific three-candle pattern. Think of it as a signal that the market was so incredibly one-sided, so aggressive, that it literally created an imbalance. Price just moved with so much force that it skipped over some price levels, leaving behind this pocket of inefficiency.
And here's how you spot it. It's actually pretty simple. You're looking at 3 candles in a row. For a bullish FVG, that middle candle is just so big and powerful that the wick of the first candle and the wick of the third candle don't overlap. That space in between, that's your gap. A super clear sign of intense, aggressive buying. And, you guessed it, the bearish FVG is just the mirror image, caused by some seriously heavy selling pressure.
All right, so now we can spot the gap on a chart. Cool. But that just tells us what happened, not why it happened. And the why is where this gets really powerful. So let's unmask the culprit behind these massive moves.
So the whole theory behind these FVGs is that they're basically the footprints of what people call smart money. Now, we're not talking about your average trader here. We're talking about the big fish, the banks, the hedge funds, the major financial institutions. Their orders are so huge that when they decide to get into the market, they can shove the price around and create these imbalances we see as gaps.
Now, the idea of imbalances in the market isn't exactly new, but the specific name fair value gap was really popularized by a trading educator who goes by ICT, or inner circle trader. He made it a cornerstone of what he calls smart money concepts, and honestly, that's why you hear this term everywhere in trading communities these days.
And this right here is the absolute core idea. The market, in theory, doesn't like these vacuums. It's inefficient. So it has a natural tendency to pull back and revisit these gapped-out areas to, well, fill the gap and allow for a more balanced, two-sided trade. And that potential trip back to the scene of the crime, that's exactly what traders are looking to play.
Okay, so let's shift gears from the why to the how. How can we turn all this detective work into an actual, actionable strategy? Now that we have our clues, let's see how we can build a plan around them.
At its heart, it really boils down to a pretty simple 3-step process. First, you spot a nice clean FVG that's heading in the same direction as the overall trend. Super important. Second, and this is key, you don't chase it. You have to be patient and wait for the price to pull back to retrace into that gap. And third, you gotta know your exits before you enter. You place your stop loss and set a logical take-profit target.
This little table lays it all out nice and simple. For a bullish setup, right, you're looking for the price to dip down into that gap, which you're now viewing as a potential support zone. Your stop loss? You tuck it just below that zone. For a bearish setup, it's the exact opposite. The gap becomes a potential resistance area and your stop goes just above it. And for your initial target, you look for a logical spot, like the most recent peak or valley in the price.
Okay, this is really, really important. A single clue is almost never enough to solve a case. A good detective and a good trader is always looking for multiple pieces of evidence that all point to the same conclusion. FVGs are powerful, for sure, but you absolutely should not trade them in a vacuum.
So, how do we build a stronger case for our trade? Well, first, like I said, always trade with the overall trend. A bullish FVG in a clear uptrend is a much higher probability setup. Second, you can use other tools for confirmation. A volume profile, for example, can show you if that gap area truly was a low volume zone. Third, think about the time frame. A gap that forms on a daily chart, that carries a lot more weight than one you see on a 1-minute chart. And finally, you look for what traders call confluence, where that FVG lines up perfectly with another key level like an old support or resistance zone.
Now, it's really easy to get excited about a new strategy, but we have to be realistic. Every single trading approach has risks, and FVG trading has its own unique set of challenges. So let's do a quick reality check. Look, no strategy is ever going to be 100% perfect. Sometimes a pattern that looks like a perfect FVG is just going to fail. That's why having that confirmation we just talked about is so crucial. Another big challenge is that sometimes the price will only dip its toe into the gap. It won't fill the whole thing before reversing. And of course, in really choppy sideways markets, these signals just aren't as reliable. It's usually best to just sit on your hands and wait for a clear trend to emerge.
Let's just be brutally honest about the most common mistakes people make. Number 1, hands down, is trying to trade an FVG against the main trend. Just don't do it. Number 2 is being impatient, seeing every tiny little gap and thinking it's a golden opportunity. You have to wait for the clean, obvious, high-quality setups. And number 3, the most critical mistake of all, is trading without a net, failing to use a clear, predefined stop loss. Every single trade needs one. No excuses.
So really, the most important point to remember is this. An FVG is a clue. It's a tool that helps you identify a potential area where big institutions might have been active. It gives you a high probability zone to keep an eye on, but it is not and never will be a foolproof crystal ball that predicts the future.
All right, let's wrap this up with a quick recap. Number 1, an FVG is just a simple 3-candle pattern that shows us a market imbalance. Number 2, the theory is that these are caused by huge institutional orders. Number 3, a basic strategy is to patiently wait for a pullback into that gap. And number 4, the golden rule, always use other tools for confirmation and have your risk managed before you even think about clicking the button.
So, the next time you open up your charts and you see one of those crazy, sudden moves that leaves a gap behind, you'll have a whole new way of looking at it. You won't just see a random price move anymore. You might just start to see the footprints of the players who are really moving the market.